Welcome to Griffonomics.
Glad to be here for this one. We've got a lot to cover.
We really do, because right now there is an $80 billion blueprint sitting on a desk in Texas that is either going to solve the global AI energy crisis, or it's going to go down as one of the most spectacular debt-fueled implosions in Wall Street history.
Yeah, and usually when we look at the AI revolution, we completely obsess over the software side.
Right.
The neural networks, the parameters, the chatbot capabilities. We treat it like it's just magic.
But that digital magic requires something brutally physical, right? And that is power, like grid-breaking, mind-boggling amounts of electricity. So today we are taking a deep dive into the ultimate high-stakes corporate drama playing out right now in the Texas Panhandle.
We are dissecting Fermi Inc., trading under the ticker FRMI. And what they're attempting doesn't just sound like science fiction. It fundamentally rewrites how infrastructure is funded in this country.
Which is wild.
It is. They are trying to transition from a pre-revenue startup into a cash-flowing AI energy utility, and they are basically trying to do it virtually overnight.
So we have a massive stack of sources to process for you today. We're pulling from their SEC 10K filings, their Q4 2025 earnings reports, shareholder letters, seeking alpha analyst reports, and yes, quite a few active litigation notices.
Lots of legal paperwork on this one.
So much. But the mission for this deep dive is to generate a granular strategic report and an actionable investment roadmap for you. We are looking at Fermi's fundamental challenge, which really boils down to a single, highly precarious race to secure their first anchor tenant.
Right, because whoever solves this power bottleneck for AI effectively holds the keys to the next decade of the global economy. I mean, this story sits at the absolute intersection of the computing arms race, national security, and billions of dollars in highly speculative leveraged infrastructure.
Why should you care? Because this affects literally everything in the tech space going forward. But to understand why their stock recently crashed 75% from its IPO, we first have to grasp the sheer, unprecedented scale of their blueprint.
Yeah, they call it the HyperGrid.
The HyperGrid. And looking at these filings, they aren't just building a power plant, they're building a private energy campus called Project Matador. We're talking about a 5,236-acre site.
And they plan to expand that to over 7,500 acres eventually.
It's massive.
Yeah.
And the entire premise is to completely bypass the congested public utility grid.
Because the interconnection queues for the public grid are currently stretching out for years. If you are a tech giant, trying to build a data center, you literally cannot afford to wait half a decade for a public utility to upgrade its transmission lines.
Right. They need power yesterday.
Exactly. So Fermi's model solves this by building the power generation directly next to the data centers. And they're targeting up to 17 gigawatts of dedicated power.
I want to pause on that number for you. 17 gigawatts. That is roughly enough to power the entirety of New York City.
It's a staggering amount of electricity.
And they're throwing an absolute kitchen sink of generation at this, too. Natural gas-fired combined cycle plants, solar arrays, massive battery energy storage systems, and eventually Westinghouse AP1000 nuclear reactors.
Yeah, they're just stacking every possible power source onto this land.
Okay, let's unpack this. It sounds like they are trying to build an entire Las Vegas Strip specifically for AI servers, complete with its own private Hoover Dam.
That is actually a perfectly accurate way to visualize it.
Okay.
But building the equivalent of a private Hoover Dam isn't even the craziest part here.
Right.
The craziest part is the financial structure. They intend to operate as a real estate investment trust, a REIT.
Wait, if they aren't selling power to the public grid, how does this REIT model actually work in practice?
The structure is highly technical, but absolutely crucial to the whole thesis. They aren't selling electricity by the kilowatt hour like a local utility would.
Because if they did that, what happened?
If they did that, they'd be taxed and regulated like a standard utility, which ruins the margins. Instead, they plan to generate revenue through long-term, triple-net, take-or-pay leases.
Okay, let's decode that jargon for a second because that's a lot. A triple net lease means the tenant, not Fermi, is taking on the bulk of the operational risk, right? They're covering property taxes, insurance, maintenance.
Correct. And the take-or-pay part means the tech giant has to pay for the reserved power capacity whether their servers are actually consuming it or not.
Wow.
Furthermore, they are charging a return on the capital they've invested into building the powered shell structures for these data centers.
But how is that legal under real estate tax rules? They're clearly a power company.
Well, the mechanism that makes this legal under REIT tax rules is a framework called the incident of tenancy.
The incident of tenancy.
Right. To maintain that highly tax-advantaged REIT status, they must provide the electricity strictly as a perk of leasing the real estate.
Ah, okay, so it's like renting an apartment where the landlord technically isn't selling you water. They are just charging you rent for the physical pipes, and the water happens to flow through them as a feature of the apartment.
Exactly. It's a brilliant legal sleight of hand to keep those massive tax advantages. The tenant pays fixed rent for the power capacity, fixed rent for the building shell, and simply reimburses Fermi for the actual natural gas consumed at cost.
So it's an $80 billion build-out built on a regulatory nuance.
Pretty much. But Fermi already has massive, irreplicable physical assets in play. I mean, they have established real operational alpha here.
Yeah, take their permitting moat, for instance. Securing environmental approval to burn natural gas right now is notoriously difficult in this country.
Oh, almost impossible in some states.
Yet the Texas Commission on Environmental Quality, the TCEQ, recently approved a historic, roughly 6 gigawatt clean air permit for Fermi's project, and they just filed for 5 gigawatts more.
Which is huge.
And now, reading through the lines of their shareholder letters, Fermi's leadership is aggressively highlighting how this project aligns with Donald Trump's executive orders on AI leadership, as well as Texas Governor Greg Abbott's energy directives.
Right. And to look at this impartially, whether you agree with that political framing or not, Fermi is clearly treating politics as a tool here.
Yeah, we're just reporting what's in the SEC documents. They are leveraging the current political urgency at the state and federal levels to accelerate their permitting process. They're basically framing their private data center project as a matter of urgent national security.
What's fascinating here is that political momentum translates directly to how they're handling their physical supply chain.
Oh, the supply chain stuff is wild.
It is, because while traditional utilities are just paralyzed by these multi-year bottlenecks waiting for transformers and turbines, Fermi already has fleets of Siemens SGT 800 gas turbines physically arriving at the Port of Houston.
Already there.
Already there. And the mechanism they use to get them there cheaply is brilliant. They utilized foreign trade zones.
Let's explain how a foreign trade zone actually works, because it's a massive logistical advantage. You literally drag a multi-ton gas turbine to a designated area in Houston, you draw an invisible line around it and tell U.S. Customs, hey, technically, this equipment is not in America yet?
Exactly. By staging the equipment in these zones, they legally kept the turbines offshore on paper.
And that dodges an estimated $30 million in tariff costs before officially importing them.
Right. They bypass the bottleneck, they save millions, and they physically possess the generation equipment. But natural gas is only the bridge for them. The real endgame for baseload clean power is nuclear.
Here's where it gets really interesting. They have the gas turbines, but what about the nuclear side? We all know nuclear power plants take decades to build.
Largely due to extreme regulatory scrutiny. But Fermi's plan to bypass that relies on a concept they're pioneering called nuclear bifurcation.
Nuclear bifurcation. This is where I had an absolute aha moment reading the filings, because historically, the entire footprint of a nuclear plant is treated as a highly sensitive radiation zone.
Right. The Nuclear Regulatory Commission subjects every single pipe and valve in the steam turbine hull to the same intense scrutiny as the reactor core itself.
Which slows everything down.
Tremendously. So Fermi is essentially building a regulatory firewall. They are physically and structurally separating the heavily regulated nuclear island from the standard industrial balance of plant.
Because, what, 80% of a nuclear power plant is just a standard steam factory, right?
Exactly. By legally separating the two, Fermi can build the steam turbines and cooling systems using standard industrial contractors at standard industrial speeds, while keeping the nuclear red tape confined strictly to the reactor itself.
So they're treating regulation as an engineering problem to be solved.
That's exactly it. And it seems to be working for them. They currently hold the only active combined operating license application accepted by the NRC in over 15 years for 4 large-scale Westinghouse AP1000 reactors.
They are also the first private company in the NRC's Accelerated Environmental Review pilot program, which is a huge deal.
And they've even signed early forging agreements with companies like Hyundai and Doosan to start manufacturing the massive steel components right now.
Wow. So having turbines in a port and permits on a desk is impressive. But pouring the concrete to actually build a 17-gigawatt facility without a single dime of revenue means they are funding this through massive, massive leverage.
Oh, absolutely. And when you look at their 2025 burn rate, the math starts to look incredibly precarious.
Let's dive into that full year 2025 review. The headline, Yap net loss was $486.4 million.
Which is terrifying on paper.
Right. When I see $500 million evaporating from a pre-revenue startup, my immediate reaction as an investor is absolute panic. But digging into the cash flow statement tells a very different story about their operational discipline.
You really have to separate the paper losses from the actual cash going out the door. The vast majority of that $486 million, over $440 million of it, actually is entirely non-cash.
Yeah, it includes a $173.8 million charitable contribution of stock, which is interesting, and $132.7 million in stock-based compensation for their executives and staff.
But when you look at their actual operating cash burn, just to keep the lights on, it was only $34.2 million.
Which is incredibly lean for a company managing an infrastructure project of this size.
Very lean. But the capital expenditures, like the actual money going into the dirt, was massive. Cash used in investing activities was $570.3 million.
Right, because they are buying the turbines, clearing the 5,000 acres, and building the substations out at Project Matador.
And they can only sustain this burn because they ended the year sitting on $408.5 million in cash, supported by over $1 billion in committed financing.
Wait, so they are bleeding $500 million on paper, but sitting on a mountain of cash and debt. What's the catch to all of this borrowed money?
Well, they lined up facilities from major heavyweights like MUFG, Keystone, and Yorkville. And crucially, they managed to refinance a bridge loan from Macquarie.
Oh, that Macquarie loan. Let's talk about that, because that carried a punishingly high interest rate of nearly 49%.
Yeah, 48.9% interest rate is basically credit card debt on steroids for $1 billion company. Getting out of that was critical.
But leverage always comes with strings, doesn't it? $1 billion in debt requires future cash flows to service it. You can only pay the bank if you have a tenant paying you rent.
Exactly. And that causality brings us directly to the catastrophic event that tanked Fermi stock and triggered the current wave of lawsuits.
Because the entire model hinges on securing that first anchor tenant.
Let's conduct some forensics on the first tenant fallout. Going into the fall of 2025, Fermi had a non-binding letter of intent with an investment-grade tech company to anchor the campus.
And in November, they formalized it further. The prospective tenant agreed to a $150 million advance in aid of construction agreement, or AIAC as they call it.
Let's explain why a tenant would even do that. The tenant essentially agreed to front $150 million to help Fermi build the shared electrical substations.
Right, and for investors, that agreement was the holy grail. It proved that hyperscalers were desperate enough for power that they were willing to put 9 figures of serious skin in the game just to secure their spot in line.
It completely validated the entire HyperGrid concept.
But then December hits.
Yeah. On December 9th, the exclusivity period in that letter of intent expired. And based on analyst forensics, the tenant saw that expiration date as massive leverage.
They knew Fermi needed a signed lease to unlock their long-term bank financing.
Exactly. So the tenant tried to change the terms of the deal at the 11th hour, likely demanding cheaper rent or much better conditions.
I mean, if I'm Fermi's management in that room, I'm staring down the barrel of a multi-billion-dollar debt load. The pressure to just sign the paper and take the bad terms must have been immense.
It had to be.
But they didn't do it. They called the tenant's bluff, they held their ground, and on December 11th, the tenant officially walked away, taking that $150 million in upfront funding with them.
And the market reaction was just brutal. The stock plummeted nearly 34% in a single trading session.
It's just wiped out.
Yeah. But management's rationale was margin protection. Signing a bad 20-year take-or-pay lease ruins the economics of the entire $80 billion project before the first server is even plugged in.
So they chose short-term pain to protect the long-term viability of the REIT.
That's their argument, yeah.
But when you wipe out a third of your market cap in a single day, you don't just get short-term pain, you get securities lawyers.
Oh, lots of them.
We've reviewed notices from several prominent class action law firms, including Bletchmar, Fonte and Auld and Hagens Berman. And impartially speaking, these lawsuits allege that Fermi overstated tenant demand during its October IPO.
Right. They claim management painted an artificially rosy picture of the first tenant agreement to secure investor financing, while allegedly concealing the severe risk that the tenant might simply walk away.
And Fermi, of course, strongly denies these allegations, stating they are completely without merit and that they simply refuse to accept unfavorable commercial terms.
We have to wait and see what the courts say.
Right.
So what does this all mean? They lost their biggest backer and they're getting sued.
Well, It forces a massive strategic pivot. You lose a $150 million commitment, the exclusivity window closes, and suddenly you are staring at a vacant lot in Texas with angry investors.
But reading the latest updates, losing that exclusivity might have actually been a weird strategic opening for them. Because they didn't just go crawling back to the other cloud providers. They started talking directly to the chip makers.
Oh, that's really smart.
It is.
Yeah.
Because a billion-dollar order of advanced AI chips from a manufacturer is completely useless if the buyer doesn't have a dedicated power source to plug them into.
Right. The hardware manufacturers are realizing they basically have to become energy brokers to ensure their products can actually be deployed. That is a brilliant shift in customer base.
Yeah.
But it hits a massive brick wall.
The credit constraint.
Yes. Fermi's management insists they are being, quote, deliberate and consistent in their search, but they absolutely must find an investment-grade counterparty.
This raises an important question, right? Why can't they just sign anyone who wants power?
Exactly.
Well, a signature from a startup with $50 million in venture funding doesn't help Fermi at all. The anchor lease is the key that unlocks the non-recourse project debt from the big banks.
Ah, so if the tenant doesn't have a bulletproof balance sheet to guarantee those 20 years of cash flows, banks like MUFG will simply not release the billions needed to actually construct the data center shell.
Precisely. And the market skepticism is deafening right now because everyone reading these SEC filings can hear the ticking clock.
The debt has strict timelines, and the land lease has strict timelines.
Let's break down the 2026 contractual cliffs, starting with the land itself.
Okay, so Fermi's Project Matador sits on a 99-year ground lease with the Texas Tech University System, the TTUS. But that lease has performance milestones. By December 31st, 2026, Fermi must sign a tenant for at least 200 megawatts of power.
And if they fail?
They risk losing their notice to proceed, which completely jeopardizes their control of the 5,200-acre site.
Wow. And without the land, the permits are useless. Without the permits, the turbines are useless.
And banks know this. The $500 million equipment facility with MUFG and the $120 million facility with Keystone are tied directly to tenant acquisition.
So if a qualifying investment-grade lease isn't signed by late 2026, these loan facilities trigger massive penalties.
Massive. We're talking mandatory prepayments or drastically steeper repayment terms that Fermi simply does not have the cash flow to survive.
It's like playing a billion-dollar game of musical chairs.
Yeah.
When the music stops in December 2026, if they don't have a hyperscaler sitting in that seat, they lose the land and the banks come knocking.
That's exactly what it is. And adding intense downward pressure to the stock price is the insider sell-down risk.
Oh, this is the ironic trap of the REIT structure they chose.
Yeah.
Because to qualify as a real estate investment trust with the IRS, you must comply with what's called the 550 rule.
Okay, what does that mean?
It mandates that 5 or fewer individuals cannot own more than 50% of the value of the stock during the last half of the taxable year.
Right. And Fermi's insiders, including CEO Toby Neugebauer, currently hold about a 38% stake.
So as the company issues more equity or as valuations shift to ensure compliance with the IRS, the CEO and insiders will be legally forced to conduct an orderly sell-down of their shares.
That's wild. Even if the CEO believes the stock is massively undervalued and doesn't want to sell, he literally has to flood the market with shares just to keep the corporate tax benefits intact.
Yeah, he has no choice. And that insider selling compounds with the dilution mechanisms built into their new financing. They secured a note with Yorkville Advisors and an equity line of credit, an ELOC.
Okay, an ELOC essentially allows Fermi to use its own stock as an ATM.
Right.
They can issue new shares to settle their monthly debt amortizations instead of paying cash. But if the stock price remains depressed because of the lost tenant, they have to issue exponentially more shares to pay off the exact same amount of debt.
Which creates a classic dilution death spiral for the everyday shareholder.
So synthesizing all this, the permits, the debt, the litigation, and the physical assets, the strategic outlook for Fermi is the absolute definition of a high speculation inflection play.
Totally. The physical assets provide a massive, irreplicable moat. I mean, you cannot instantly duplicate a 6-gigawatt TCEQ air permit, active nuclear licenses, and physical gas turbines already sitting in Texas.
You just can't. But the entire thesis is binary. It's a zero-sum game that hinges entirely on securing that first binding hyperscaler lease before the late 2026 contractual cliffs hit.
Yeah, if they sign the tenant, it validates the triple net model, it unlocks the project debt, and they own the most valuable AI real estate in the world.
But if they don't, the debt covenants bite, the TCUS land lease is threatened, the dilution spirals, and the liquidity runway just vanishes entirely.
The leverage dynamics over the next 18 months will completely dictate the survival of the company.
I want to leave you with one final mind-bending twist that we pulled from deep inside the Q&A portion of their Q4 earnings call.
This is my favorite part.
It's so good. We have spent this entire deep dive analyzing Fermi's desperate race to find a tenant. But what if the bottleneck isn't Fermi's ability to generate the power?
Right.
What if the bottleneck is the tech giant's ability to actually build data centers fast enough to use it?
Because Fermi is currently having to conduct what their CFO termed reverse due diligence on prospective tenants.
Think about that. Fermi has the turbines, they have the air permits, they have the land ready to go. But before they sign a lease, Fermi has to investigate whether these multi-trillion-dollar tech giants actually have the modular MEP, the physical, mechanical, electrical, and plumbing infrastructure to absorb gigawatts of power on this accelerated timeline.
It flips the entire market narrative on its head.
It really does. We all assume the AI companies are just waiting on the grid, but maybe the tech giants are the ones holding up the AI revolution because they literally can't source the cooling pipes and rack the servers fast enough to take the power Fermi is offering.
Something for you to chew on the next time you ask a chatbot a question.
Risk defined, portfolio protected.